best period was up 18%. In the worst, it was 6%. Make sure that's not 8. And then bonds, 12 and 1, and then the balanced portfolio, 14 versus 5%. So time horizon is something you should consider because it really makes a big difference in terms of how much volatility and risk you can accept and what your risk tolerance really is. Yeah.
Yeah, when it's appropriate, I'd like you to speak about gold, silver,
Okay.
things that, you know, when we had a economist talk to us at our veterinary congress in BMG last year, I believe. And of course, he spoke about from the economy point of view, and then he went to the level of 2030, where the world will see the greatest depression it's ever seen.
Okay.
And I know
Doomsday
that's a long
scenario.
time, but, so, you know, you read certain things, do you recommend having something as an asset like that that's probably not necessarily going to give you a great return, but
Sure.
how do you work that into your portfolio, or do you?
Right, right. So gold and silver, or commodities in general, precious metals in that case, once again, that's a commodity, and they go through big swings. Gold's a little bit different because typically the US dollar was backed up by gold, pre-Bretton Woods, the gold standard. I have a tough time owning gold just because I feel like it's a metal that doesn't have that much utility. I guess for me, it's been an inflation hedge over time, along with other precious metals. But I'd rather own a productive asset that's going to produce income. And if doomsday actually comes and we go through the worst depression in 2030, what do you want to own? You probably want to have some agriculture. You want to have something that's going to sustain yourself. You're going to probably want to own some weapons, honestly. classic firearms. These things appreciate in value. I mean, things that are going to be so. But no, I do get his scenario that you know, typically
I've already got one
been,
of those.
So I guess at certain points in the commodity cycle, even as early as early February of this year, own mining stocks, own Barrick Gold, own some of these stocks that have just been crushed, own Rio Tinto, BHP Billiton, own Outright Gold ETF, or other, you know, iron ore or things like that. But really, it's based on cycles and fear. And what's fearful now is not going to be fearful later. And the contrarian in me says that, you know, in the depths when there's blood in the streets and the assets are all depressed, that's when you want to buy. And it can be gold. It can be, it can be an auto part company. It can be an out-price retailer like TJ Maxx. So I guess, you know, gold at times is going to have a decent part of a portfolio in terms of asset allocation, but you have to be careful with it too.
Great, thank you.
So time horizon is really important. And something you should also consider is inflation. We talked about this briefly earlier. Inflation is your worst enemy. It's an investor's worst enemy. It's eroding the value of your portfolio continuously. And inflation right now with the CPI at about 1.5%. It's not that high right now. But when you think about where bonds are, your real return is really zero. But in the short term, it's volatility risk. The blue line represents volatility risk. That's very high in the short term. As you go long term, volatility declines. We talked about that ad nauseum. Inflation risk is your big risk. And really, you know, getting a real return and increasing the purchasing power of your portfolio, if that's your goal, that's kind of a big thing. It's paramount. On the next page, slide 15, one thing we need to all realize is that rates are really low. Bonds are no longer a safe haven. Just today, the 10-year Treasury was 1.86%. Talked about 1.5% in terms of inflation. That's probably moving to 2 or 2.5% at some point over the next couple of years. So really, if you lock in on that bond, and it's nice to lock in on something that you know what the annual return's going to be over 10 years. But the problem is you might be locking in a negative real return. So it's going to erode the purchasing power of your portfolio. So bonds are no longer a safe haven. On slide 16, diversification. It's very important in considering what your asset allocation is going to be. So the bulk of returns for the average investor are determined by how they behave at market peaks and drops. Typically, the average investor behaves very poorly. They typically buy high and sell low. It's emotional, it's a psychological thing. Julia mentioned it. People get scared. The headline risk, the blood in the streets, people want to sell. A lot of people did this on March 9th of 2009. So the average investor has really behaved poorly over time. So in our opinion, it's important to have a plan, be disciplined about the plan, stick to the plan, and rebalance as necessary as you see opportunity. But this on the bottom highlights some of the various returns. And actually, gold is mentioned in here as an asset class. And I apologize, this is really only through 2014, but directionally it's correct. REITs, real estate investment trusts, over the last 20 years have been the best performing asset class, 11.5%. The S&P 500 is up 9.9%. A 60 portfolio of 60% stocks, 40% fixed income is up 8.7, so actually right in the hunt. So on and so forth. If you go over and look at the average investor has had a 2.5% return per year. So that's just not good, and it's not going to meet your goals, likely, in terms of spending, beating inflation, and taxes. So having a diversified portfolio and a plan and rebalancing is very important. So the next section is on actually establishing your asset allocation. Anybody have any questions? We can go back to it. So on page 19, what you need to do really is determine what your goals are and what your risk tolerance is. And then you can kind of classify and figure out where you line up on this chart. If you're more into wealth preservation, you're conservative, you don't want volatility in your portfolio, you might need some current income, which is tough to come by with low bond rates right now. But you're likely going to have more fixed income, less equities, and we call that more capital preservation. If you are planning on being a little more aggressive, you want some wealth accumulation, you can seek, or you're seeking long-term growth in capital, and you can tolerate some volatility and risk, you're in the wealth accumulation phase, and you're going to like a portfolio that's more capital appreciation. It's going to be more equity oriented. I'm guessing most of you are probably going to be somewhere in the middle, balanced. You're going to have some equities, some fixed income. You're going to have some other strategies, some alternatives perhaps. Perhaps you own real estate, you own the building that your vet practices are in. Keep that. That might be considered an alternative as well. But it's going to be more of a balanced asset allocation. The next page, so these are the asset allocation categories that we're currently investing in. And cash, that's self-explanatory. Defensive assets, we consider this investment grade fixed income. And the reason we call it defensive assets is that we found out that during the financial crisis, all fixed income wasn't fixed income. Even highly rated fixed income sometimes didn't pay out or actually give a return at the end. Credit strategies, this is really kind of alternative fixed income, and it's focused more on some funds that might have a little bit of credit risk, but very little interest rate risk. Diversified market strategies, this really is alternatives that have a place in the portfolio that exhibit very low correlation to core stocks and core bonds. So it's meant more of as a hedge. And then growth assets, this is going to be your long-only equities. You have large cap, mid cap, small cap, international developed, emerging market, so on and so forth. And then a liquid alternatives, this can be private equity, private real estate, private credit, venture capital, secondary private equity, all kinds of things there.
I have a question.
Yeah.
Just on your second catch, defensive asset, you have your chart with the bonds. You list bonds there, but then you said that bonds may not, obviously, the rates are going to go up. Historically, we've been low, so it's been good for 20 years.
It's been good for 20 years.
Yeah, so is that a defensive strategy?
That's a very good question. So it probably is going to prove that it's more risky from a purchasing power perspective. However, if you look at what happened for the first 2.5 months this year, really into early March. Municipal bonds were the best performing asset class. During that time period, the S&P 500 was down from peak to trough, starting from the beginning of the year through the bottom was down maybe 12 or 13%. So municipal bonds, when rates go down, they're going to go up. Now I can make the case that given all the global debt at the country level, federal debt, sovereign debt, and the need to really finance future deficits spending and entitlement spending, that debt is going to be more prevalent as we go forward, and rates are going to stay low for a very long time. So is it going to be defensive? Probably not from a purchasing power perspective, but rates can stay low for a long time, and they can still stay low for the next 5 to 10 years. So I kind of danced around the answer on that question, but I think it deserves a part of a client portfolio just because it is a hedge in case things really unravel. And in terms of current asset allocation, what are we thinking about? Defensive assets, we're actually trying to keep duration short here, 4 to 5 years, and this just alludes to what we just currently talked about. Duration is basically average maturity. We typically ladder portfolios, and the average maturity is going to be 4 to 5 years. Whereas, a 30-year treasury, I'm not sure what the rate is, maybe 2.75 or 3% right now. That's very, very aggressive, and it can lose a lot of value if rates do go up.
Mike, comment about bond fund versus individual bonds.
Sure. Yeah. So owning individual bonds versus owning a bond fund. I'm talking about investment grade credit, both corporate, municipal bonds, and treasuries. If rates do go up, typically bond values do go down. But if it's in a mutual fund format, they have no control over the flows that go into and out of the fund. So if you hold an individual bond, you know what your return is going to be because you know you're probably going to hold that to maturity or the call date. Whereas if you hold an actual bond mutual fund, the maturity dates are all over the place. If people are pulling money from that bond fund because rates are going up and performance is poor, they might be forced to sell bonds at a very low price, and essentially you're going to lose your principal right there. You can't lock in contractually what your return would be if you owned an individual bond. So we do individual bonds, and if you're going to own a bond fund, investment grade bond fund, you might want to keep the duration very short, like less than 3 or 4 years. Vanguard has some pretty good ones, short-term bond index and short to intermediate bond index. And then in terms of credit strategies, we kind of started adding these to client portfolios just in response to low interest rates. So with a portion of maturing and called bonds in client portfolios, we've been adding positions in some high yield bonds and then mortgage-backed securities. And these are actually in the form of 40 Act mutual funds, institutional mutual funds. And these are a little bit different because duration is very short here anyway, and they don't really take interest rate risk. In terms of diversified market strategies, once again, these are different alternatives that have low correlation to core stocks and bonds. We have placed money into a market neutral fund, which a market neutral fund really is betting on cheap stocks going up and expensive stocks going down, and simply closing the spread between the cheap and the expensive as they come to some median valuation. And that's, once again, a good hedge in client portfolios. And then growth assets, the categories that we utilize are U.S. equities, developed international equities, and emerging market. We are heavily focused on U.S. equities relative to developed and emerging markets. So of the growth assets in a client portfolio, we recommend 75% in U.S. stocks, and then 25% spread half and half between developed international and emerging markets.
So in your diversified market strategies,
Yep.
Are you doing options or shorts or?
We aren't doing the individual shorts or the individual options ourselves. We're finding outside funds to invest or separately managed accounts to do this for us, for our clients. What we do in-house, proprietary to our clients at Evercore, is individual bonds, defensive assets, and then we do U.S. equities, core equity. So,
And
Right.
that's a large percentage of the.
and that's a large percentage of a balanced account.
Just
Yep.
a quick question, because some of us don't live in this world, and could you explain hedge just a little bit more thoroughly?
Yeah, so I think there's a difference between a hedge and a hedge fund. A hedge really is just meant to offset another risk in your portfolio. And a hedge fund really is more of a private vehicle. You might have some illiquidity in the actual fund. They typically charge really high fees. We've shied away from hedge funds. Typically, it's 2% of assets under management plus a 20% carried interest fee or performance fee, and typically they're not very tax efficient. So we're looking for tax efficiency for our clients just because most of our clients are not institutional endowments, and we think long-term investment is just the way to go in general. That just implies that it's tax efficient. So as I mentioned, 75% in U.S. equities. Most of our clients are U.S. clients. They spend U.S. dollars. So we feel like we shouldn't have to put too much of their assets at risk in other foreign currencies, which can fluctuate greatly. But also, we just like the U.S. We think the U.S. is just the best country to invest in, and that's proven to be the case for a long time. In terms of U.S. equities, we like I mentioned, we have a 40-stock core equity portfolio. Myself and 2 gentlemen in New York and 2 gentlemen in San Francisco manage that portfolio. We focus on companies that we can hold for at least 3 years, very low turnover. We're looking for the best businesses, the best management teams, and if you get invested with these good businesses with good products that can sustain themselves for a number of years, that's the best investment advice I can give you. Invest in good companies and have it compound over time. Don't look at it. The market shouldn't price daily, 5 days a week. I wish it didn't, because people would have better emotions then. And anyway, so then in terms of developed international equities, we actually use a passive fund here, but it's passive with a tilt. It's focused more on small cap value companies. Small cap value international is kind of an untapped market. It's very inefficient. We feel like that's a good investment. And then emerging market equities, we aren't focused on commodities. We haven't been focused on commodities since mid-2013, so we're not focused on Brazil, Russia, South Africa. We have focused more on the emerging Asian consumer. We think that's a good storyline to play out, and it's more focused on utilities, consumer staples, consumer discretionary, healthcare, financial companies, very little in industrials and commodities. And then in illiquid alternatives, we found opportunity in middle market lending, and then secondary private equity. And I know I'm kind of getting away from the asset allocation discussion, but this is kind of areas that we think are attractive. So turning the page.
What are some examples of that, the illiquid alternatives?
Oh, yeah, sure. So for us, it's really a rifle shot approach.
A what?
I call it a rifle shot approach. We have a number of funds pitch us, and then we try to figure out what the hot asset class or what we think the good asset class is going to be, and then we try to figure out a nice vehicle for our clients. But it can be private equity funds, middle market lending. We own a fund that's based in New York that has a 7-year lockup. It just distributes income quarterly. Returns here have been 12 to 15% per year. Lately, they've been more 11 to 12%, and it's been a very good investment for our clients. So middle market lending has been a good area to be in. Secondary private equity. This is really just recycled limited partners. If you think about what happens in terms of a life event, a divorce, it might force a wealthy individual to get rid of their private equity. You can buy this stuff at a severe discount to what they paid for it, and you can get in more at the bottom of what we call the J curve and reap more of the upside. So really it's buying out limited partners, which is a liquid, at a very big discount, and you can get nice returns. That was only open to us in terms of where we thought the good returns were for maybe 12 months, and then it was exploited.
20%.
And it can be venture capital. It can be the stuff you see about going on out in Silicon Valley. It can be distressed credit. Distressed credit in early 2009 was just a really fat pitch. And You know, so a variety of things, and typically these are locked up, you know, somewhere between 5 and 10 years. In some cases, some of the stuff that was done more in the dot-com boom back in the late 90s and 2000, some of that stuff is still actually playing itself out because they haven't distributed money just because the valuations haven't allowed the company to be sold at a good value. And typically, you know, if you're getting involved in a liquids, at a very minimum, it's typically $100,000 for one limited partner slot. Typically, it's $250,000. If you're thinking about like the really good distressed credit junk managers like Oaktree out of LA, I think the minimum there might be $1 million or $5 million per limited partner. And the returns here are all over the board. That's why it's pretty good. It's very appropriate to diversify amongst vintage year and then amongst asset class if you're doing private equity. And typically, it's a very few managers that really hit that top decile of return. But we've also done some non-performing residential real estate loans, but that opportunity closed up pretty quick too.
Can you mention
Oh, and we also have a 40 Act. We also have a 40 Act mutual fund called the Evercore Equity Fund. Follows our core equity. And okay, so the next page, page 22. What is the right asset allocation for you? Once again, it's dependent on your goals, your risk tolerance. Your portfolio should be in place to enhance returns and reduce volatility to meet your return goals. We had talked about returns before, whether it's 7%, 5%, 6%. I encourage you all to model very conservatively because you'll be happily surprised in the end. And then your objectives and your asset allocation should be reviewed regularly. And I encourage you all to have an investment policy statement. An investment policy statement is kind of a document basically that you can go back to and say, these are my strategic ranges for my asset allocation. This is how much equities I want. This is how much fixed income. This is how much cash. You can always go back to this document and it can serve as kind of a guidepost for you. And you can carry this with you from place to place. And it needs to be reviewed regularly, at least once a year, your asset allocation, or when you have major life changes, like a lot of you are having soon, it sounds like. In terms of what is the right asset allocation for you, here's some examples that we've developed. And once again, I'll mention that my client who's 82 years old, he only wants to own stocks, and he's done really well. And then some clients want to be very conservative. But you'll see kind of the capital appreciation portfolio right here. It might have 32% equities. It might have 47% fixed income. It might have a certain amount of cash that you need as liabilities come up. And compare that to the more aggressive capital appreciation, 65% equities, fixed income, cash, and then a slug of illiquids, and then diversified market strategies. The core of our portfolios, we think, should be in investment-grade bonds in core equities or growth assets. It's a good way to keep fees down as well. Diversified market strategies, while they're not hedge fund type fees, they tend to have a little bit higher fee of assets under management, and then a lot of these illiquid assets will have performance fees or carried interest fees as well. And then also, balanced could be something like maybe half equities and half just other assets, the core of which is fixed income.
Could you just review, like, really quickly, what you think a reasonable range of fees for these different things are? Like,
Sure.
you've thrown out, and someone, I think you mentioned before, that the annuity fees are high, but what does that mean
Sure.
to us? Does that mean
Yeah.
like twice as much, 3 times as much, or
Sure.
0.5% more?
Yep. So, if you're paying for active management in equities,
Right.
it'll probably be more like 1%.
Okay.
If you're passive in equities and you want to own, the S&P 500 SPDR index fund or a Vanguard
Right.
mutual fund, you can get all the way down to 8 to 10%.
How much?
I'm sorry, 8 to 10 basis points.
That's-
So it's a point.
It's 0.08.
Okay,
Yep,
okay.
or 0.1%, call it.
All right.
Inclusive of all fees, even those that are like, because there's fees that are in there as part of the,
Oh, hidden fees.
Yeah.
Yeah. So, yeah, I mean, so, if you're buying a mutual fund, there could be a front-end load, there can be a
I'm
12.
talking no load though, but
Sure.
they're, you know, it's buried
But there's
in there.
trading costs, right?
Yeah.
So, typically with an index fund, turnover is gonna be very low, so trading costs is gonna be very low as well. You're talking, you know, for a big institution like Vanguard or Fidelity, you're probably talking like 2 or 3 cents a share, so very low. One of the problems with index funds in terms of, you know, taxes is you can't really manage taxes. So if you're looking at owning individual equities, you can manage taxes if you have a long-term approach. If you have a loss in Home Depot, you can swap out of Home Depot and you can buy Lowe's 31 days, you can swap back and you can take the tax loss and reset your cost basis in Home Depot. And then in terms of fixed income, you know, I can maybe tell you what our fee schedule is for a $10 million account. So we charge 35 basis points for our fixed income, so 0.35%. We think that's pretty competitive. We have an active credit analyst who's going out and actually doing the credit work in the municipality and figuring out which way the water flows, looking at the budgets, looking at the deficits. And we want all of our bonds to be money good, which, you know, as we talked about during the financial crisis, some of these, even municipal bonds were very stressed. And we've seen some bankruptcies in Sacramento and other municipalities. And then in terms of diversified market strategies, you know, you might pay 1.5 to 2% here in this is as opposed to an illiquid hedge fund, like I had mentioned. Illiquid assets, you're gonna pay for a private equity fund, probably 2% of AUM, and maybe a 10 to 15% performance fee over a high water mark, meaning they have to return, you know, in excess of 7%, and then the performance fee is on top of that. It gives them a good incentive to perform well, but they're gonna charge you for it too, but the goal is to get the, you know, really get the best manager, and you're gonna have good performance. Does that help a little bit? Or-
Yeah, and also then, the annuities.
The annuities,
I
you know,
think you really just need to shop, because I
There's-
think there's
A big
a
range.
big range.
What is that range?
I don't think I can tell you. I haven't looked at it in the last year. I had somebody that had one prior. I can get back to you. I'll send it to
And you
Jeff
can
and he
post
can
it.
route it.
Okay.
And is there any data out there looking at, I mean, cause you can listen to Bob Brinker and he says, just don't use money managers at all, just get index funds.
Sure.
And then you can listen to, you know, somebody else say asset allocation, active management's the way to go. Listen to somebody else, tactical management is the way to go. Somebody says, you know, you gotta have an annuity as part of your thing, somebody else, so it's kinda like, we're just bombarded and but is there any data, like you put up a great graph showing over time, 20 years, you know, balanced portfolios doing this.
Yep.
Has anybody done any data showing if you are under active management, net of fees versus just doing index funds, you know, are you in better shape that way over time?
So the average active manager gross in fees outperforms, and this is for large cap, US, outperforms the S&P 500. Net of fees, 2/3 underperform. And this is a study that's been done, you know, since maybe 35, 40 years. It's just a known fact. And, you know, I think that where you wanna place your bet or bets are in markets where you think you have talented individuals selecting stocks or selecting securities, or inefficient markets. I'll cite municipal bonds. So you can buy a municipal bond from a brokerage house out of their inventory, and if you aren't going out to 50 or 60 different brokerage houses or bond dealers, you're gonna be beholden to that one broker's price. So if you have a financial advisor at some broker and you wanna buy a municipal bond, you have no idea what the fair value of that bond when you purchase it is. So we have a neat slide, which I forgot to bring, and Julie told me I should bring it. we have some examples of the price spreads that we received from we actually use 80 different bond dealers that we solicit bids from, of a particular bond that we knew they had inventory of, and the range was like 6%. And when you think about how low the interest rate environment was, the range was like $101, and par is 100, to $107. So you can eat up all your return by overpaying for that bond. And so I think active management in bonds is important. So it's very efficient as a class.
So you were just talking about the fees from your companies, and so what I thought I heard from you is that there's a different fee structure depending on what asset class you're talking about.
There can be,
It
yes.
can be, but do you have an overall fee to managing a certain size portfolio? There must be some override, so you guys get paid rather than
Yep,
just all the other
exactly.
people getting paid. Which is
Exactly.
fine.
So an all-in blended rate on a $10 million portfolio for us, we're gonna charge 1% on equities, all equities. And we'll have the bulk of the equities in our core equity. We'll make bets in emerging markets, international developed markets. And we'll charge 35 basis points on fixed income, cash, and credit strategies. And the blended fee typically on, call it a 70-30 portfolio, is somewhere around 75 basis points, 75 to 80 basis points. And then we have breakpoints that go, if it's over $10 million in equity, there's certain breakpoints beyond that. And if it's over $10 million in bonds.
Is that the minimum that you do?
Our minimum is 5.
Fine, so that's gonna be a higher rate, I would expect.
Right. Right.
What is that?
And at
At
the
5.
breakpoints, 5, it's 1% total.
Straight
But-
across?
But I have authority to give you guys 35 on bonds anyway.
So it'd be 35, it would be the same fee structure as a $10 million account for a $5 million account.
So do you have different benchmarks for your different allocations, like you have the capital preservation?
Yep.
You have the balance and the capital appreciation. Are you using standard and Poor or 500 index for all of them? Or do you
Yeah.
look at capital preservation, which you're preserving the capital, but you may not be preserving the buying power
Purchasing
of that,
power, right.
so
Right.
what, you use different indices or benchmarks for each one of these asset allocations?
Yep, so depending on what your goals are, we can set up having an absolute benchmark, which really might be, inflation plus 4% or something like that, or 3%. And a lot of foundations will do that, or endowments. They'll have that benchmark because a foundation's gonna have to distribute 5% per year minimum.